think about it from the point of view of the entrepreneur. If their equity is negative, right, they're basically wiped out. So they really have nothing to lose anymore. So it's almost like a scenario where basically the entrepreneur is sort of gambling with the bank's money, because all their equity has no value. It's negative, so it's gone. So the only person who really sort of got any sort of skin in the game is the bank. We don't want that. We want as bankers, we want the entrepreneurs to have their money on the line too, so they're motivated not to screw this up. Equity financing. Equity financing is basically, again, probably comes a little bit later. They're in the cycle, right? This is where you're giving up part ownership. Now there are, of course, different ways of structuring this. There are different types of equity. You can have just common stock versus preferred stock, right? There's also all these different hybrid types of equity. You can have sometimes like convertible stock, where like maybe it starts out as debt, but then the person holding it can convert it to stock. Sometimes convertible type securities. Okay, so there's all this different cool stuff you can look into, but the basic gist of equity is part ownership of the company, right? So now you're sort of in business with the entrepreneur. And one of the problems with equity is that, let's say the company goes bankrupt. These banks, debtors, usually get paid first. And usually the pecking order is the secured creditors, like banks, get paid off first. Then maybe like the workers might get paid next for back wages. Then unsecured creditors, and then lastly is the equity guys. These guys always get paid off last, all right, when companies go bankrupt. So they're taking a little bit more risk. And usually, if I remember correctly, the preferred shareholders might get paid first, I think, and then last, and very last is common shareholders, I believe, is how it goes. This is a huge topic. These are some options, like angel investors, venture capitalists, public offerings, initial public offerings, and private placements. Quickly, angel investors. Again, these are 4 different possible scenarios of how you could get equity financing. Angel investors are usually like 55-year-olds who have been previous entrepreneurs. They're usually fairly wealthy. They're usually male, actually. It doesn't have to be, but typically they are. And well off, and they're interested in being involved in the entrepreneurial process. They want to sort of maybe mentor the new entrepreneur who's maybe younger, help bring them up. Venture capitalists are sort of like big sort of pools of money that are managed by professionals who are basically deciding, they, for instance, what might be happening is maybe a bunch of companies that already exist are contributing to, let's say, some sort of pension plan. So the venture capitalist is getting this big pool of money coming in. And the idea here is to invest in different, more than one usually, startup, well, not startups, but entrepreneurial companies. Usually they're beyond the startup phase. These guys usually come later in the cycle. When the entrepreneurial company has proven itself to have some sort of track record, and they're looking for rapidly growing companies to get nice, juicy returns on investment. These guys usually want higher returns. They're also are usually investing larger amounts of money. They might be investing $20 million, but they usually want lots of ownership and because they're putting in lots of money. Right? You put in a lot more money, you want more say in what happens. Initial public offerings are now, normally what happens here is the entrepreneur doesn't do this by him or herself. usually the venture capitalist provides support. This is where we're bringing in things like investment banking, right? Sometimes you'll hear, especially now with the American situation, with all these banking crises and so on going on in the States, you hear about different types of banks. There's sort of a difference between commercial banks and investment banks. Okay, you're all familiar with commercial banks, right? This is like you go down to your Royal Bank of Canada, you have your checking account, commercial, right? Your TD Canada Trust, you have your credit card, your Visa cards, your stuff like this. That's pretty much commercial banking, okay, dealing with the public, the average Joe Blow off the street. Investment banking is a little bit different. These guys are basically, what that basically means is they're helping the entrepreneurial company sell its stocks and sell its bonds. Investment banking is also involved with helping, let's say, governments. Say the government needs to raise $500 billion in bonds and sell all of these. So effectively that's what they pretty much are. Investment banking is basically like a bunch of guys going around helping companies sell stocks and bonds. Okay, and so that's why we usually have these venture capitalists come on board, because they have more expertise, because they're professional finance people, to help you go public. And private placement would be, let's say, if you sell pretty much all your stock to one company, to one investor, pretty much, or a very small group, as opposed to public would be like hundreds and hundreds of people would own your stock. Private placement might be 3 people own all your stock. Okay, characteristics of firms that use equity financing. Again, they usually come later in the growth of the company. Again, look at this thing, unique business idea. Boy, oh boy, uniqueness, that sounds almost like core competency stuff. Remember we talked about strategic resources and strategic assets? Remember in our business model stuff? So it's unique ideas, high growth, niche, again, so that's marketing, market segmentation, proven management, again, organizational feasibility. We want to make sure we have management track record, can execute. Equity investors are looking for capital gains, right? There's a couple ways you can make money as an investor, right? One way is through interest, right? I lend you $100 and interest rate 6%, you pay me $6 in interest. Another way you can make money is through dividends. This basically means I, investor, I'm not lending, but I'm buying stock in your company, and the company hopefully makes some profit. They can keep some of that profit, plow it back in to the company. The retained earnings, basically. The company makes profit, has retained earnings, right? They're retaining them. What does it do with this net income? Well, one, as I said, is plow it back and keep it in the company, retain it. The other option is take the net income, the net profit, and pay it out to shareholders. That's what we call dividends. This capital gains are great for longer term perspective. What this basically means is you buy a stock for $2 a share, and hopefully when you go sell it, it's worth $20 a share. So you make $18 per share capital gains. So this is buying assets, and then hopefully the prices go up. So that's what capital gains. The other reason, of course, this is very relevant for Canada, is dividends, interest, and capital gains are taxed differently. Okay, interest is usually the worst for taxes because they tax it like income, like you had a job. But capital gains, you have a couple things that are good for capital gain investors. Is you have the fact that you get this, basically they don't tax all of it, first of all, right? So in other words, if I remember correctly, let's say you have $100 in capital gains. Okay, that's what really happened, reality. But they sort of pretend it's like $50.